Welcome to Yahoo Finance Live. I'm Shauna Smith along with Diane King Hall. And let's get you up to speed on the market action. Risk off trading action here as we count down the final hour of trading. Stocks falling. We had that weaker than expected trade data out of China this morning. Also a credit rating downgrade on U.S. banks. That's weighing on investor sentiment. You can really see the declines here across the board. The Dow off the lows of the session, but still down just around 184 points. S&P trading to the downside off just about 0.5%. The Nasdaq, the worst performer, the three major averages off nearly 1%. And when you take a look at the sector action, technology, materials, financials, among the worst performers of today. Energy and healthcare, the only two sectors trading to the upside here. Let's first get to that big market story of the day, one of the big stories, and that's regional banks. They are continue to be under pressure following Moody's cutting its rating on 10 small and mid-sized banks, citing, quote, growing profitability pressures in the industry. Moody's also put several larger lenders, including State Street, U.S. Bancorp, and Bank of New York Mellon, on watch for a possible downgrade. And Diane, when you take a look at the reasons as to why Moody's is a bit cautious here, lower profits, higher funding costs, obviously a concern here. All cuts were by a single notch, but really still shows that the banking sector is still vulnerable, given the macroeconomic landscape. Exactly.
Still not out of the woods yet with regard, and it had been kind of quiet in that sector, although they hadn't completely recovered from what we saw, the drawdowns earlier in the year with regard to the regional banking crisis and the issues that led to the failure of SVB. And, you know, starting obviously first with First Republic and just concerns about just the liquidity issues, et cetera. And just even the potential for outflows from these banks. It just shows there are still some issues and worries with regard to this sector. But as you mentioned, the broader market off its lows, also these regionals off their lows. So M&T is still down, obviously, one of the banks that got hit in this downgrade, down 1 3/4% about there. Pinnacle also under some pressure, down more than 2% at the moment. And you got Webster Financial also off 1.5 or a little over 1.5% now at the moment. So these stocks just continuing to get hit in the aftermath of that downgrade. And it seems like there's a theme this month already, downgrades, right?
Yeah, certainly some downgrades. There's some reasons to worry here as we kick off the final month of the summer. But when it comes to some of these risks here, obviously commercial real estate, the exposure there among some of these smaller and mid-sized banks, that's one of the big reasons as to why Moody's did initiate this downgrade here, just in terms of their exposure with the higher rates, declines in office demand. We've seen that already clearly reshape the commercial real estate landscape. So what that outlook looks like going forward, uncertainty there, a reason why Moody's is a little bit hesitant, at least for now.
I wanted to pivot to another stock that we're watching, shares of UPS getting a ding. That stock down more than 1% at the moment. It's off the back of its latest quarterly report card. The shipping giant reported a big drop in revenue and profit. Profit fell some 24% to $2.2 billion on an adjusted basis, or $2.54 a share. The company also slashed its guidance off the heels of its latest numbers, in part because of the cost of its tentative labor deal with the Teamsters Union. We know that deal had come to the forefront recently. It's a costly deal. It's not been ratified yet. It's expected to, I guess, be ratified later this month, but it's certainly taking a bite out of its numbers, Shauna.
Yeah, it certainly is. And that negotiation there with the Teamsters really proving to be a bit more disruptive than management maybe expected, given that cut that we got to guidance, at some of those higher costs associated with this agreement. But this move lower that we're seeing today, it's all about that outlook, that cut in the revenue forecast for the year. They now see revenue of $93 billion. That was down from their prior guidance of just around $97 billion. The intraday drop that we were looking at earlier was the biggest intraday drop that we had seen since April. When it comes to the second quarter results, so domestic, international, that was both hurt by the drop in volume. U.S. package revenue was down 7% from a year ago. International package revenue off 13% from a year ago. So some weakness there, obviously being reflected in the shares move today, off just about 1%.
Yeah, and they had warned that volume would be lower. You know, they had alerted about a softening economy and the impact there. So you're certainly seeing that in terms of the numbers, as you mentioned, with regard to both domestic and international volume.
Well, let's take a look at one of the gainers of today, one of the winners in today's trading action, and that is Eli Lilly, surging up just about 15%. The drug maker reporting a beat on the top and bottom line. Its diabetes treatment, Mounjaro, was a big driver for revenue during the quarter. Eli Lilly also raising its full year guidance. These Mounjaro sales numbers are pretty incredible, Diane.
Yes, I was literally
72% in the second quarter from the prior quarter, totaling $979 million. They are expecting that U.S. decision on use of this drug for weight loss later this year, but a huge driver in revenue for the most recent quarter, but also obviously as you look ahead to the remainder of the year.
Right. And when you think about you mentioned the numbers with regard to Mounjaro, to put that in even broader perspective, you go back to 2022, it just brought in $16 million in sales last year. And compare that to the number we're hearing now, $979 million. It hasn't even been approved yet for the weight loss functionality. I mean, we know that they filed for approval of Mounjaro for weight management. They filed for that approval last month. So again, it hasn't even been approved for that yet. You know?
Yeah, certainly really speaks to what that demand picture could look like here on out, given what those expectations are.
All right, we want to get back to regionals. It's been a rough year for regionals. It just got worse. Moody's Investor Service has announced they cut ratings for several small to mid-sized lenders, including M&T Bank and Pinnacle Financial. The agency flagged concerns over commercial real estate risks, as well as possible regulatory capital weakness. Moody's also lowered its outlook for nearly a dozen banks, including Capital One, Citizens Financial, leaving one to wonder, are we in for another banking crisis this year? Joining us now to discuss is Kevin Flanagan, Wisdom Tree Head of Fixed Income Strategy. Kevin, thanks so much for joining us today. So first off, in terms of your reaction to this news out today, this seems like it was a surprise. Are you still concerned about issues within the regional banking sector?
Well, it was a surprise only because we've tended to put things on the back burner after what you all were mentioning earlier with SVB and some of the other banks back in March. But the underlying issues were always still there. And I think that's what Moody's was responding to. So, we've talked about it before. Bank runs, is it going to be a bank walk? If you look at deposit rates, what are being paid there, or you could get 5%, say, in Treasury floating rate notes, Treasury bills. So some of these issues in commercial real estate, they're not going away anytime soon. But there is good news. And the good news is something we didn't have, say, 5 months ago, was the Bank Term Funding Program from the Fed. And that will play, I think, a very important role in giving investors, I think, some confidence or some comfort that what appears to be a regional banking issue does not become a systemic banking issue.
Kevin, if we do see, though, some of those 6 larger banks that were placed on review for potential downgrade here from Moody's, will that at all change your outlook, change your strategy, given the fact that maybe some of the issues are wider spread than many investors had initially anticipated?
Well, not really. You know why? Because we've been following Chairman Powell, and somewhat interestingly, in his press conferences following the last couple of Fed meetings and in the policy statement itself from the Fed, they always are mentioning tightening financial conditions from the regional bank stresses or turmoil. So once again, something that was there that just kind of went away. It was back on the back burner on simmer, and now being brought out again more to the front end of the burner, more of a boiling kind of situation, especially when you get a rating agency act like that. So I think tighter financial conditions in conjunction with the Fed rate hikes leads you to believe that at some point the economy is probably going to have to give up some ground, and maybe you finally do get a negative quarter of GDP.
Kevin, I want to ask you, so there's been obviously talk of more regulation with regard to the regional banks. If and when regulation gets tighter for that part of the banking sector, what does that signal for the bond market? Does it bode well for the bond market?
Well, I mean, to your point, the regulatory aspect takes time to be administered and then to actually come into and be signed into law. So I think, for the more intermediate term impact, there probably isn't going to be all that much. I think what you saw today, though, was a perfect example of maybe what investors should expect going forward. Notwithstanding the Fitch downgrade last week, the global investment community, just like an S&P downgrade in 2011, still view treasuries as the store of value. So in times of uncertainty, in times of risk off, money flows into treasuries. Today was a perfect example of that. I heard in your prior segment talking about the disappointing Chinese trade data. You have the Moody's action today. You had an Italian tax on profit windfalls for banks over there. So all of that created this kind of risk-off environment today. And what happens? The 10-year Treasury yield drops about 8 or 9 basis points.
Kevin, let's talk a little bit more about that trade data out of China, because we did see a slump in Chinese imports and exports in the month of July. It was far worse than expected. China's imports are down more than 12% in the last year. Exports contracting 14.5%. How are you looking at this from an investment perspective, and really what it highlights or what it shows just about some of the worries about the slowing global economy and what that means for investors here in the U.S.?
Well, you hit the nail on the head, right? I think this is indicative of a slowing global economy. So China gets hit on both fronts of trade on that front, the import and the export side of the ledger. And I think going forward, one should probably, if you're looking to invest, and this is a bond guy talking, but if you're looking to invest, I think, into Asia, perhaps Japan is an area that investors may look to as an alternative, a China alternative coming into Japan. And I know we've been seeing or witnessing flows on that front.
And Kevin, I want to ask you again, given some of that weakness in the so-called reopening recovery that we've seen in China, what are the protective measures that an investor needs to take in this kind of climate? And again, I know that your expertise is obviously fixed income, and that's your focus. So how can one be protective in this kind of market?
Well, I just a balanced portfolio, right? I think you need to look at the state of where things are here on August 8th, 2023. Completely different than what we had expected, right? I think if we had been talking 6 months ago, we'd probably be saying, how long do you think this recession's going to last? So things change, and things don't always go according to scripts that appear to be what everybody's talking about. So I would say a balanced portfolio. And on the bond side, a barbell strategy. So you're really not taking a rate call per se. In other words, you have short duration, you have long duration, and you're kind of mixing the two together. So you don't have to make a specific rate call. So you don't have to be concerned, should I go long duration? Should I be short here? And taking advantage of what the yield curve is giving you at this stage of the game, which, as I mentioned earlier, are rates that we haven't seen in quite some time. A generation of investors, I would argue, have not seen 5% Treasury yields, especially in areas like floating rate notes.
Kevin, do you think the Treasury market, do you think it's getting the message from the Fed? Do you think it's finally pricing in what's expected in terms of this higher for longer environment that Powell, like you said, has been calling for now for quite some time, or warning about for quite some time?
Yeah, I mean, that's a great question. And I think the problem with the Fed and the Fed chairman was their transitory argument. So I think it took the markets longer, perhaps, than what normally would be the case to come around to the Fed messaging. I find it interesting that there is apparently, from what you keep reading about, a little bit of a mini battle going on at the Fed between the moderates who want to stop rate hikes, and then you have the Fed governors like Waller of the world, speaking about maybe we need still yet another rate hike. So I think that dynamic in the Fed is going to continue, but the bottom line message, I think that's important. And you just mentioned it, rates higher for longer, even though we may be at or close to the end of this rate hike cycle. What we're not close to are Fed rate cuts. And that's a dramatic difference from what we would have been talking about just a couple months ago.
Well, we will certainly see if the fixed income and equity market has priced higher for longer correctly soon. Kevin Flanagan, WisdomTree Head of Fixed Income Strategy. Thanks, Kevin.
Thank you.
Let's do a check of the market sponsored by Tasty Trade. You're looking at losses across the board, although equity markets off the lows of the session. The Dow now off 179 points. Worst performer inside the Dow is Goldman. Goldman Sachs off just about 2%, followed by Salesforce and Microsoft. Financials and technology sectors among the worst performers today. We had Moody's cutting ratings on 10 small and medium-sized banks earlier in today's trading action. Also, weak trade data out of China that is weighing on investor sentiment today. And taking a look at the VIX and the impact that we are seeing there. You're looking at the VIX, the fear gauge index, trading just to the upside here, up about 3.5%, 1632.
All right, we are just getting started here on Yahoo Finance Live. Coming up, joint ventures. Anheuser-Busch just made a deal with Tilray, giving the cannabis company 8 of its brands. Tilray shares lighting up on the news. We'll speak to the CEO of Tilray on the other side. And gas prices are up nearly 30 cents from a month ago. Consumers are taking notice. We'll break down the impact to your wallet. And many Americans could lose out on a lot of money from Social Security payments down the line. Find out how you can get your full payment when Yahoo Finance returns.
It's been a wild year in the retail space. Inflation has dominated the headlines, causing shoppers to spend more cautiously.
As a result, profits at major retailers such as Walmart, Target, and others have come under pressure.
Organized crime and a growing list of bankruptcies also continue to cast a shadow over the entire industry.
But what does this all mean for the future of the sector? Should investors dive in or steer clear of retail stocks?
We'll bring you key analysis and hear from some of the biggest names in the industry to answer key questions.
Who is the consumer visiting? What can retailers do to stop the rise in theft? Are more bankruptcies on the horizon? And where does AI fit into it all? It's all part of our week-long special, Retail Evolution, The New Era, starting Monday, August 14th, right here on Yahoo Finance. You won't want to miss it.
You're watching Yahoo Finance. I'm Julie Hyman. Well, Anheuser-Busch announcing they're going to sell 8 of their beverage labels to Tilray brands. The portfolio includes popular names like Shock Top and Red Hook. The deal, expected to close this year, also included current employees, breweries, and brew pubs related to those beverage makers. And joining me now to talk all about it is Irwin Simon. He is the CEO of Tilray, and you see some of the cans there of those beverages behind him and some of the existing brands as well. Irwin, it's great to see you. This just the latest deal that you have done. Talk to me about how this one fits into not just the existing portfolio, but the strategy overall of the company.
So, Julie, good afternoon. Great to see you. And here's a lot of our great beer brands and our spirit brands. Listen, I think the exciting thing is, and you've seen what Hain Celestial, what I was able to do is bring a bunch of brands and diversify the company into multiple categories. Not dissimilar here. When I got, to a free in 2018, we were a $50 million business. We're approaching close to $1 billion in size. And, one of the challenges I ran into was with cannabis was not knowing what legalization was going to happen. Legalization happened in Canada, medical legalization happened in Europe, in multiple countries, but everybody was waiting for the U.S. And with that, it took a lot of predictability away from earnings and revenue generating. And I think you saw so many cannabis companies where their stocks just got hit hard. And what I wanted to do was make sure we were not dependent upon legalization. We had a good income stream. We had revenue stream. We had predictability of earnings. And I wanted to diversify the company. But what was important, that we had adjacencies out there that they could bring it all together. So today, our cannabis business in Canada, we have the number one position with a 13% share, is about 30% of our revenue. Now with our Montauk, our Sweetwater, and our 8 beers that we're acquiring from ABI, along with our Breckenridge and Manitoba Harvest. And then our international business, which is about 30% of our business, and our Manitoba Harvest, gives us a good diversification, gives us ultimately that we can bring it together upon legalization. And very few companies out there today have what we have in beer, spirits, cannabis, and medical cannabis.
So, Irwin, as one of the analysts on the call pointed out, this portfolio of beer brands that you're buying, or I should say beer brands and an energy drink brand in Highball, this portfolio has been seeing declines in the past several years. How do you plan to turn that around? Does being part of your bigger portfolio help you with that strategically?
So number one, listen, we bought Sweetwater in November 2020, and it was not really growing. Montauk was growing. When we bought Green Flash, Alpine, and Nelson's, they weren't growing. So we've done a great job in turning around beer businesses that we acquired. And if I come back, the big thing that I'm focused on here, no different than I looked at the natural organic food industry, no different than I looked at the cannabis world, is ultimately, I think there's such opportunity within the craft beer business. Constellation has left the craft beer business. There's a lot of confusion out there with the craft beer business. And the strategy within Tilray is, how do we make craft beer cool again? And with that, a lot of consumers were drinking the vodka seltzers and vodka, mixed with sodas and stuff like that. I think taking our current brands and taking with the ABI brands that we're acquiring, we can really bring some good energy and good fun into the craft beer business and make it cool and fun again. And that's what the plan is.
How do you do that? How do you make them cool again?
So listen, you can't just stack them high and watch them fly. And you got to connect with consumers. You got to connect with the Gen Z. You got to connect with baby boomers. You got to let them know what is exciting about beer today. And listen, we've done that in regards to our 420 with Montauk. We've done that in regards to gummy beers coming out in regards to Sweetwater. Some of the other IPAs that we launched with packaging and bottles, et cetera. We revolved a lot around concerts and music, et cetera. So again, it's coming up with unique products, it's connecting to the consumer. And with that, we'll hopefully get these products growing in the right direction and giving them attention. Absolutely, you got to spend money on them. You got to ultimately, enhance some of the packaging. And I think there's such big opportunities. I think the opportunities with Shop Top, I think the opportunities, in regards to some of these other ones, Blue Point, you put Blue Point and, Montauk together, I think there is such great opportunities and synergies to market them alongside each other here in the New York area. So, what it does for Tilray also, it allows us to put together a national beer business today, and allows us to put together our distributors, allows us to become more important to distributors, more important to retailers, and ultimately it's important to let the consumer know how we're all combined and connected.
And as you mentioned, part of the original impetus behind getting into this business was to sort of serve as a bridge, right? To sort of smooth out revenue in what is an unpredictable time. When we would have talked a couple of years ago, it seemed like at that point that federal legalization was closer than it feels like it is right now. What's your current thinking on that?
And, great question. I can't predict what our government is going to do. Cannabis is legal in about 37 different, states out there in regards to medical or recreational. So I can't sit back and sort of wait and say, hey, it's going to be legal next year. Originally, I thought when the Biden administration, it'd be legal today, but that's not the case. So what I need to do for our shareholders is to have predictability on revenues and growth. And ultimately, we're well positioned upon legalization where the adjacencies, and there's no reason you cannot have beer out there without alcohol, of course, that is infused with THC, and consumers want that. There's no reason you can't have spirits out there that are infused with THC. So I think, ultimately, we're well positioned. And when legalization happens, not if, when it happens, we're ready for it. We're one of the largest growers in Canada. We have over 5 million square feet of grow space. We really know how to grow cannabis. We know how to develop products in the cannabis space. We're going to get better in the beer business in regards to craft beers and some of the uniqueness. We're in the spirits business with our bourbons and vodkas and gin products. So we're in these businesses today. And ultimately, how do we all pull together? And when legalization happens, we're ready to, come out there with beers and bourbons and that would are fused with THC.
And Erwin, finally, a quick question on deal process, because obviously the other party involved in this deal has gotten a lot of headlines lately in the form of Anheuser-Busch and with Bud Light in particular. Have you had your eye on these brands for a while, and sort of maybe some of the challenges at Anheuser-Busch lately opened the door for them to be more willing to sell these brands to you guys?
Listen, I picked up the phone and called ABI and, explained to them what I was trying to do. And they were great to work with. And I think they saw right reasons why it made sense to divest. And we're taking all their people that come along with this here. We're working with them on a transition. So, I think it's totally separate. And I'm sure that we would have been able to work with ABI if they, were not dealing with some of the other stuff they are. But it's, again, having the vision for Tilray, and no different than having the vision in buying Montauk or having the vision to buy Sweetwater, was ultimately we needed distribution in the Pacific Northwest. We needed more manufacturing for Montauk, in the Northeast here, and Blue Point came along with that. The cider business, which is an excellent growing business and, pretty exciting with Highball, I still think there's big upside on the, on the energy drink business. So it really fit perfect with what we're trying to do. Right. Some of these beers will be sold in Canada. So the opportunity, for us is tremendous.
Well, Erwin, thank you so much for catching up with us today about this. Tilray CEO, Erwin Simon. Tilray, one of the top trending tickers on Yahoo Finance today. Thanks, Erwin.
Thank you. Nice to see you, Julie.
You
Enjoy
too.
the rest of your summer.
Thank you. You too.
Thank
Take
you.
care. Shauna.
All right, Julie, thanks so much. Thanks so much for bringing us that conversation. Well, gas prices, they keep climbing. The national average is $3.82 a gallon. That's according to AAA, up nearly 30 cents from just a month ago. Here with a closer look at what this means for consumer spending, Yahoo Finance's Brooke DePalma is digging into this for us. And Brooke, obviously, higher gas prices, it's something that Americans, that consumers notice right away.
Yeah, notice right away. One of the two biggest things that Americans notice is gas prices and food prices. So when gas prices rise, it ultimately then takes a toll on their spending power, or really the way that they perceive perceive their spending power in this economy. And so really an economist from S&P Global Market Intelligence told Yahoo Finance that there's about a 70% correlation between gas prices and the way that consumers think of the U.S. economy. And now when you take into consideration where we're at right now with $3.82 per gallon, of course that's lower than last year, but it still could have larger implications here. And eToro, global market strategist, really broke this down for Yahoo Finance, saying that when you take a recent low like $3.09 and you compare that to where we're at now with $3.83 as of Monday, that's an extra annual cost of roughly $101 billion for U.S. consumers in total. Now, that's based on an estimate that Americans use roughly 375 million gallons of gas each day. But ultimately, bottom line here, that means less money in Americans' pockets to go out and spend on things like retail, back to school, entertainment, restaurants, and so on. And so with these high prices, while they're expected to sort of remain high but not move higher, it'll be interesting to see the toll that this takes on Americans.
Yeah, indeed. I mean, I even noticed an uptick recently when I was filling up at the pump. Not so much that it was like unbearable, obviously, but I noticed that uptick. And that's not the only factor, though, that is hitting consumers. So what else is on the horizon that could impact things further, Brooke?
Yeah, well, right now, all Americans are sort of on watch for inflation, for higher costs, especially at the pump. But really, young as well as young consumers, as well as low-income consumers, really on watch here. When you think about the looming return of student loan payments, higher mortgage rates, higher interest rates, higher costs of groceries. Again, we're getting a new read on CPI this Thursday. Now, these are all things that Americans fear. And so when they think about these gas prices, it sort of leads to a somewhat of a sour outlook for spending, or rather S&P Global Market Intelligence analysts really telling us that it sours their outlook for what Americans can spend. And when you think about back to school, higher costs, higher inflation taking a toll on Americans' wallets, on that disposable income, well, U.S. parents are all taking this into consideration. BNP Paribas also telling Yahoo Finance that excess savings that we saw back in 2021 is starting to run down, and they do expect that it might even be depleted by the end of the year. And then in addition to that, what we're seeing here with retail earnings out next week, what this ultimately means for retailers, we're seeing a lot of discounting there, perhaps a different change of behavior, perhaps Americans buying less this back to school season. And while they won't be reflected next week in quarterly earnings, this is something that Wall Street's certainly looking out for as well.
I mean, it will affect current quarter results when we talk about looking ahead to the next quarter, right? Brooke, thanks so much. Well, coming up next, most Americans don't plan to wait until they're 70 years old to collect Social Security benefits, but it could be a big mistake. Find out why next.
We are introducing a new segment here. Yahoo Finance has launched the YF chart book. It's a basket of approximately 50 charts from Wall Street analysts. The charts give vital insight to the U.S. economy and points to where it is going. We're kicking it off today with a look at luxury travel and what it tells us about recession, government grants, fraud, and the effect the pandemic has had on high and low-income earners. Danielle DiMartino Booth of Quill Intelligence created this and can go into the details. So, Danielle, thanks so much for joining us today. First off, tell us what this chart signals at a high kind of headline level.
So I think the background here is understanding what the employee retention credit is. It was created as part of the CARES Act, and it was designed for smaller businesses who kept their employees on the payroll, who had their business interrupted in 2020, such that they could claw back up to $21,000 per employee when filing their 2020 tax return. That was extended and expanded greatly by the Biden administration with the first stimulus check that they signed in. It extended out to the first 3 quarters of 2021 and also applied up to $26,000 per payroll taxes, including startups that rose like a phoenix out of the ashes of the pandemic. And that is where I think the IRS has really started to combat a lot of the fraud that it's facing with this program. To give you a feel for the scope, about last year, about this time, we were talking about 15, maybe to $20 billion a month. But by the time December rolled around, claims were getting paid out to the effect of almost $26 billion a month. In July, we had more than $30 billion paid out in these income tax credits. They're mostly going to the top 20% of earners in America, who are largely taking these proceeds, these taxpayer dollars, and splurging on fancy international travel.
So, Danielle, what do you think demand looks like from here on out? Is this something that you see carrying through the end of the year? Is this a trend that you see continuing into 2024?
So it's interesting, even though the IRS has made several very public advisories saying that they're having trouble combating the fraud, they have also said that they've got an equal backlog. They've processed about 1.1 million of these employee retention credit claims. They say that they've got an equal number on the other side, and there are very aggressive marketing campaigns, getrefunds.com, innovationtaxes.com, where they collect a large contingency fee to file these claims. So at best look, we could potentially see $400 billion go towards consumer spending, directly deposited into the accounts of, again, higher income earning Americans. And this is why we have not seen a recession in 2023, in good part, in addition to other fiscal stimulus that's happening, given we know that the private sector is largely pulled back from investing, and given we know that the other 80% of income earners are really struggling to make those basic necessity type of payments as they stare down the barrel of student loan payments resuming on October the 1st. So this really is a story of the haves and the have-nots. But a $400 billion a year run rate for U.S. consumption, that would come out to about 1.5% of GDP growth. It's a big number.
Right. And Danielle, to your point, one thing we want to keep in mind is often we quote this statistic about how much the consumer is responsible for the U.S. economy. And the consumer has certainly been propping up the economy, continuing to spend on experiences and, to your data point, luxury travel. Do you see that having any kind of slowdown in the latter part of this year?
I do. We've gotten warnings from Alaska Airlines, Southwest Airlines, JetBlue was the most recent. Hotels are starting to slow as well, all domestically. So some of the lower paying type of travel we're really seeing get hit. And we're also seeing rejection rates among lenders. This is New York Federal Reserve data. We're seeing rejection rates go up very quickly, whether you're talking about a U.S. household looking to take out a credit card or increase the limit on their credit card or buy a new car. So you're putting up a slide here that's very, very telling. And that's exactly what we've been hearing from a lot of these airlines. What they're not seeing domestically, they're certainly seeing internationally, and international brick and mortar sales. Call it the Champs-Élysées effect, as a result of these government payouts has been extraordinary. The growth has been amazing. I've heard that from my friends in Europe. We're seeing tons of Americans.
Daniel, when it comes to what the Fed could do, should do next, obviously given your experience, prior experience at the Fed, just what's your assessment of this higher for longer policy, the restrictive policy that the U.S. economy faces, and its ability to withstand the fact that we could be looking at much higher rates going into the new year?
So, we're hearing from Fannie Mae, we're hearing from others that U.S. households are taking out home equity lines of credit at a greater pace. My goodness, that's a 9% borrowing rate. And yet the Fed intends fully on, from what we've heard from Fed speakers in the last few days, potentially pausing here, but staying at these high levels into next year. And continuing to reduce the size of the Federal Reserve's balance sheet, which pulls liquidity out of the system. We've had a particularly busy few days on the bankruptcy front, whether you're talking about a hospital or an airline company or yellow trucking, as we've seen. But the bankruptcies are spreading out beyond a few sectors, and I think that that's really relevant and reflective of the Fed staying higher for longer. It costs more money to conduct business and or to refinance your debt, whether you're a corporation or a U.S. household.
All right. Well, we will have to put a pin in our conversation there. Quill Intelligence CEO Danielle DiMartino, thank you so much for both being a part of this new segment, Why of Chart Books and Beyond.
Thank you for having me.
Got it.
Well, many Americans are planning to claim Social Security benefits before they're 70 years old, despite knowing that putting it off will result in higher payments. For more on this, we turn to Yahoo Finance's Carrie Hanning. Carrie, before we get to why Americans should maybe put off those payments, why are they choosing to take it early? What do we know about that?
Yeah, absolutely, Shauna. Pretty clear reasons. As you said, 10% say before age 70. They're certainly not going to wait. And 40% said that between 62 and 65, which is before their full retirement ages. And, Social Security has been seeing this happening over the years. They have found that roughly half of Americans, take it before their full retirement age. Here's why. The first reason is they are afraid that Social Security will simply run out of money before they reach age 70. And they don't want to wait and take that chance that the money's not going to be there for them. The second reason is that they need the money now. They need the money right now. So that's a leading reason as well. The second reason is the third reason is they say, oh my gosh, this is my money and I want it ASAP. I've paid into this and I want it now. And the final reason is that they say that financial advisors are telling them to take it early. So those are the four main reasons that we see people dipping in before age 70. And let me break it down really quickly. Why this is important for future financial security is that, yes, in fact, you can take your Social Security monthly check starting at age 62. But if you wait until your full retirement age, which right now ranges between 66 and 67. Then if you take it at 62, you're going to get a 30% reduction in what your monthly check would be. Now, if you can wait from your full retirement age until age 70, each year it will bump up an annual 8% credit, which increases your monthly check by 8% each of those years, which is a very nice chunk of change at the end. And one example I saw recently is if a worker was at 62, were to take their payment today, their monthly check today, Social Security, or if they waited till age 70, there would be a $2,000 difference in what their check would be at age 70. So it is worth noting that the financial payback of waiting is there. But one caveat I have to make is simply not everyone has that luxury to wait, because they actually, especially people who are low income, or if you have a health issue, financial stresses. This is, a lot of people don't have that luxury to actually push back to age 70. But even if you could wait to your full retirement age, that would be beneficial.
So, Carrie, what's your advice to Americans on ways to wait to claim benefits, especially you made the point that some people are taking it early because they need it now. How can they hold off on it?
Yeah, that's a great question. The thing is, you need a couple things. If you have enough time, really focus on your pre-retirement savings in savings accounts, your retirement plan, as much as you can do there. So you're not going to be as dependent on that Social Security check. So if you have some time to retirement, really focus on being able to do that. The second thing I advise people to do is really to think about working longer or working part-time or flexibly in retirement. And again, one caveat, not everyone's going to be able to do this. It's usually people who have higher education that have this ability to continue to work longer. But if you can, really be proactive about that early on. Start 5 years before retirement to add skills, pay attention to where your industry is going, reach out, network, anything you can do to stay engaged, vibrant, and someone that's relevant to the workplace that I'm going to say, hey, I want to keep him or her on the payrolls for just a bit longer because they're really adding value.
Some important advice there. Carrie Hennon, always great to get your perspective. Thanks so much. Well, coming up, Disney results on deck tomorrow. Find out what investors and what Wall Street will be looking for in that report. We got that for you next. It's a big week of earnings reports from media giants. Paramount posting a Q2 results on Monday. The stock initially popping on stronger than expected results and progress in its streaming business. Now the company also announced the sale of Simon & Schuster for $1.6 billion. And these results putting some pressure on Disney to deliver. Investors are awaiting those results after the bell tomorrow. For more on the streamers and the future of TV, we want to turn to Peter Ligori. He's Sunday Gravy Entertainment President and former Tribune Media CEO. Peter, it's great to see you. So let's talk about what we've learned from Paramount and what it means for the broader media landscape. So Paramount Global beating expectations, strong growth in its streaming business. What does this tell us just about how the broader media landscape looks right now and how Paramount's positioned within that very, very competitive industry?
Well, I think the good news is they've narrowed their loss. They were able to gain 700,000 new subs. They cut their losses, but in fact, they still have losses. And it's reflective of what's going on overall in the industry, where the income coming in for the revenue for streamers is much different and much less than what it is in the typical linear cable model, where you have the dual revenue streams of affiliate fees and advertising. So good news is going in the positive direction. Challenge still is getting streaming to replicate the profits of that dual revenue stream from linear cable.
And Peter, Diane here, I want to ask you just about streaming in general, whether we're talking about a Paramount or recently Warner Brothers Discovery, which saw a loss of subscribers. And when you're talking about streaming in general, whether they're growing, it's slow growth, or some are losing subscribers, and you have Disney coming up in terms of its quarterly results. Has streaming hit a wall in terms of its growth?
Well, it's certainly slowing. And, I'd like to take a step back on Warner's. Yes, Warner's did lose some subscribers, but I would credit that to the friction of them combining their services. There's no indication that this has anything to do with the quality of their content or the quality of their offering. But there's zero doubt that there is some plateauing. There's zero doubt that streaming services will. I used to work at HBO. No matter what our program offering was, we wound up consistently having a 50% churn rate. New subscribers leaving. I think with the maturity of streaming, you're going to wind up noticing those levels of churn and a kind of leveling off of the growth. But there's still growth. There's still a trajectory there.
Peter, how much pressure does this place on Disney, just in terms of, we've heard from Bob Iger, he sounds like he's weighing almost all options at this point when it comes to the media strategy going forward, what he should do with ABC, FX, the roadmap, what that looks like for ESPN going forward. How do you see that moving forward and what those best options would look like?
Well, the claim that got the most press was his discussion about his linear networks, FX, ABC, the local stations. And look, everything should be on the table here, but it's really a matter of value. Those linear assets are, even though cord cutting is happening, those are some very, very profitable businesses, and they throw off a lot of cash. So the question would be, if they're going to sell, what's the offer? What's the present value of that money versus looking at the profits these businesses throw off over time?
And Peter, then speaking just more directly about Disney, what pieces of the business where it looks weaker, where they need to sell that off?
Look, I think Disney's pretty strong across the board. I don't think there is a need. Disney, much like Warner Brothers, much like Comcast with the Sky acquisition, each of these companies have a fair amount of debt. And you saw David and Gunnar at Warner Brothers do a very good job of figuring out how to activate their free cash flow. They prepaid some debt. They wound up with $100 million extra in free cash flow to activate in various elements of the business. So, I don't think there's any quote unquote needs. But every one of the legacy media entities should be looking at their assets and seeing how they can be activated to take care of the balance sheet and invest in the future.
Peter, who are the buyers in this scenario? Who would want to own some of these assets?
So, traditionally, I think we've seen some of the private equity companies take a look at them. When I was at Tribune, we had Oaktree heavily involved in the station group. We've seen Apollo. So what private equity does is they sit there and they do value the cash flow that these businesses throw off. It's a little bit more challenging when you try to combine station groups because you run into FTC issues.
And Peter, I want to ask you about the strike, whether we're talking about both the writers and the actors strike. Right now, it's been kind of accretive to these media companies, Paramount talking about some of the cash they've been able to conserve as a result. But when does this become a problem? There was concern expressed ahead of some of these earnings coming out. When does this become a problem for these big media giants?
Well, I think you have to work backwards. It becomes a problem when they start noticing a softening of advertising. It becomes a problem when they start softening viewership, usership, and subscriber growth. But we're not there yet. Look, there are 600 scripted shows out there right now. So there's always something fresh for someone to watch. Eventually, you do run out of something new or something that speaks to you. But these are some smart people. They will get a deal done. What's going to be interesting, about how this strike is handled is when you look at the studios, the challenge is there's almost three layers, three constituents. There's Netflix, which is kind of an island unto itself. There is Silicon Valley, the Amazons of this world who have content kind of as an ancillary strategy. And then you have legacy media. So their kind of needs are a little bit different. And from the actors and the writers' perspective, look, this is an existential issue when they're looking at AI. But I'm somewhat hopeful. Clearly there was progress being made on the SAG front because they kept extending the negotiations. That means that there were practical issues that were being addressed and some progress being made. And I'm hopeful that the WGA will look at the DGA's agreement and say there's some analogous situations there that will lead to an issue-by-issue resolution for both sides.
Hopefully there is a resolution sooner rather than later. Peter Liguori, great to have you. Sunday Gravy Entertainment President.
Thank you.
Speaking of Disney, it's gearing up to report its quarterly results amid a tough year for the media giant. The company has seen its parks business slow, coupled with declining subscriber numbers for Disney+, all while the fate of ESPN remains to be seen. Here with more on what investors can expect ahead of the company's third quarter results, we have Yahoo Finance's Alexandra Canal. Allie?
Hi, guys. Well, it's going to be a pretty challenged quarter for Disney. That's what analysts and investors expect. We're going to see likely more subscriber declines in the quarter. Remember, last quarter, Disney shed 4 million subscribers. It's going to be around the same this time, 3.6 million compared to the prior quarter. Now, streaming losses, they're also expected to come in higher on a sequential basis, 770 million compared to a loss of 1.1 billion from the prior year period. So on a year-over-year comparison, we're doing somewhat better, but still, I mean, those losses are just so significant. Bob Iger has consistently maintained that the company will reach streaming profitability by 2024. But if we keep seeing those losses, I think that's going to be really difficult, and it's going to be a bumpy journey ahead. And speaking of bumpy, advertising still a significant headwind. We're expected to see linear networks revenue for that segment decline about 6%. And the previous guest was just discussing the future of traditional TV assets. That's something I'm sure investors are going to want to hear more of on the call. Then if you take a look at the film side, we didn't have a ton of great successes with The Little Mermaid and Elemental disappointing. So it just feels like there are a lot of hurdles that this company has to deal with. And then in the background, you have the future of ESPN and taking that direct to consumer.
Indeed. Well, you're going to be busy.
I know. I was writing this up. Like, there are so many facets of this business, and it's a very difficult time right now. Shares are down about 20%.
And so much of it's also going to come on the earnings call, right?
Definitely.
A little bit more about Iger's vision and what he sees as the priorities here going forward.
And why he needed to stay longer.
Yep, exactly. End of 2026.
Indeed. All right, Allie Canal, thank you so much. Coming up, the closing bell on Wall Street. We're checking in on the latest market movers and the top trending tickers. Stay tuned.
That's the closing bell on Wall Street. Let's do a check of the market sponsored by Tasty Trade. All three of the major averages closing to the downside. The Dow off just around 150 points, well off its lows of the session, have been off more than 450 points earlier in the trading day. The S&P closing off just about 0.4%. The Nasdaq off just over 100 points. The Nasdaq now down more than 3% since the start of the month. And we take a look at the sector action today, financials and technology among the worst performers in today's trading action. All right, shares of AMC closing the day here following results on earnings, closing off just about 0.5%. Earnings did beat during the second quarter. The movie theater chain swung to a profit and its revenue grew 15% from a year ago. Looking ahead to the current quarter, CEO Adam Aron stating that, quote, the third quarter of 2023 is off to an explosive start with Barbie, Oppenheimer, and others combining to cause July to become the highest monthly revenue in AMC's storied 103-year history. So certainly July very strong from the box office for AMC. When it comes to the numbers that we just got for the most recent quarter, attendance numbers back up to where they were pre-pandemic, the highest quarterly attendance that we've seen since the fourth quarter of 2019.
Yeah, and it was a surprise profit, actually. And the stock initially popped on the news before coming back down off of that pop. And, you know, they released before the bell today. We were originally expecting them later, you know, so they did have strong performance from Super Mario Brothers in the quarter of the earnings that were just released. I mean, that was the first billion-dollar movie of the year. Barbie has now become a billion-dollar bet, paying off. But then some of the problem going forward is how much these strikes could impact the film landscape in the future. So that could certainly be one of the challenges coming into play for AMC. Again, it was a beat, you know, net income $8.6 million or a share. Better than a loss, but, you know, not enough to please Wall Street. And we know this is a meme stock, so it kind of fluctuates in response. Another stock we're watching, shares of Beyond Meat, headed to the beyond. That stock finished the day sharply lower, down double digits. We're looking at it at extended hours, but it was down double digits for the day. This after the plant-based meat company reported weaker than expected earnings. It cut its full year revenue guidance and said it no longer believes it will reach profitability this year. You're looking at the chart where it was down 14% for the day. Beyond Meat now sees full year revenue in a range of $360 million to $375 million. It previously seen revenue in a range of $375 million to $415 million. So it just shows that demand isn't there for the alternative meat. Fake meat.
Demand is not there, Diane, and we were looking at the biggest drop that we've seen since 2020. It fell as much as 21% earlier in today's trading action. And this is a company that struggled now for quite some time, really trying to get investors back on board with their vision, and they've really struggled to expand their share within the industry. There was some reaction to these results. Piper Sandler saying that they remain bullish on the stock, given some of the margins here that continue to be pressured. Also, sales growth and momentum has yet to materialize. There was maybe some improvement in the second half, which would be consistent with Piper Sandler's guidance, but still many of the headwinds, the risks there outweighing some of the progress that we could see in the second half of the year for Beyond Meat.
Right, and it's certainly a lot of the what we're seeing with regard to the stock price reflected in the future outlook being cut. It reduced it to between 360 to 380 million for the year. That's down from between 9 to 14% from last year. And you know, it just shows that the question of will they be able to continue to perform as well as they did a few years ago, it's not there.
Yeah, exactly. Yeah, the sentiment around the stock has certainly changed since then. All right, let's take a look at DraftKings closing the day higher. Got an upgrade from Truist, closing up just about 0.25%, but analyst Barry Jonas boosting his rating on the stock to a buy from hold, also raising his price target to $44 a share, citing a clear path to significant and sustainable profitability as the company narrows the gap between themselves and FanDuel, which is by far the leader within the category. But Truist in this note saying, quote, the training wheels are off. DraftKings topped their profit expectations in the second quarter earnings report that came out last week. So they are showing some progress on that front. And Truist very bullish in terms of the catalyst here going forward, able to at least see a pathway here for DraftKings to narrow FanDuel's lead within this sector, and they see growth of just about $13 a share here in the near term.
Yeah, I mean, they're not the only one. It follows on the heels of upgrades from JMP Securities and Wells Fargo. Wells Fargo upgraded DraftKings to overweight from equal weight. They raised their price target to $37. $37. Their rationale was just faster, steeper growth of EBITDA. You also had JMP Securities. They raised their price target to $39, so even higher than Wells Fargo. So they all three of these guys seeing future growth within this, also seeing positive EBITDA there for DraftKings. So it certainly has some wind under its wings there for DraftKings as it continues to grow in that space. Want to switch gears and look at the healthcare sector. Novavax is out with a surprise profit in the second quarter. The company also beating on the top line, but trimming back its full year revenue forecast for 2023. Here with the details on Novavax's latest quarterly results, we want to bring in Yahoo Finance's Anjali Khemlani. Anj?
Hey, yeah, thanks so much. You know, Novavax really is an interesting story, and I think definitely interest has waned in it over time, but they really came out with a momentary surprise with that beat in revenue, and that comes from an advance purchase agreement with Canada that then came back to them in the total of $350 million, and that's what gave them that $58 million profit this time for this quarter alone. And, you know, they do have that boost in revenue quarter over quarter. They did have to, though, downgrade their guidance for the year. And that's something that investors are definitely looking at, that downward guidance of about $100 million. They do still anticipate that they will have a decent commercialized market this fall. So they're looking at Q4 and saying that things are pretty much set when it comes to what the company needs to do. I got a chance to speak to the chief business officer and executive vice president John Trezino about what has happened and pretty much what they expect looking out for the year, what their thoughts are about, you know, the quarter and its strong results. And he told me, quote, I think we find ourselves in a much stronger financial position than we have for the last 2 quarters. And that's, you know, saying something in terms of not just the results now, but also what the company has been doing since the turnover, since the new CEO stepped in place, as well as that sort of revitalized relationship that they have with the FDA. So things looking positive for the first time in a while for this company.
And sticking with, let's talk about these health sector new trial results from Novo Nordisk showing the weight loss drug Wegovy reducing health risks. What details do you have there?
That's another interesting one. So 20% reduction in cardiovascular events. That includes heart attacks and strokes and the like. Novo Nordisk didn't get a total breakdown of which one per se was impacted more, but this is in obese patients who are also non-diabetics but are at risk for some of these. This has pushed Novo Nordisk to get its drug, the only one approved for obesity, by the way, to file for expanded use. So now it's, you know, it could be, if the FDA approves it, used for these conditions as well, and that gives it more market opportunity. It also boosts the insurance coverage argument. That is something that has really been weighing on access for this drug, whether you talk about Ozempic or Mounjaro or the other GLP-1s. You know, companies have really been hit hard with the cost of these drugs, and insurers as well. So there's been a lot of talk about whether or not this could help open the door and solve that problem, where largely you're looking at really a cash pay population or limited access for type 2 diabetes patients. So that's some positive news. Of course, Lilly up on that news as well because of its drug Mounjaro. So boosting 2 stocks today, more than 15%.
Well, that's a big move right there. All right, Anjali Khemlani, thanks so much.
All right, we got some breaking news. Shares of Lyft really exploding to the upside here in after-hours trading following their most recent earnings results. We're looking at gains of just about 12%. The big driver here, it's all about guidance. Q3 revenue guidance coming in better than expected. Lyft now sees revenue of $1.13 billion to $1.15 billion for the current quarter. The estimate on the street was for $1.08 billion. Lyft also sees adjusted EBITDA of $75 million to $85 million, blowing past the expectations of just around $47 million. For the second quarter, adjusted EPS coming in better than expected at 16 cents. The street was bracing for a loss of about a penny. Revenue in line with expectations, $1.02 billion. Active riders, a metric, a number very closely watched here from the street. That was up 8% from a year ago to 21.5 million. And also beat the street's expectations of 21.1 million. One data point here that did come in a bit light, a bit short of the street's expectations here, Diane, and that's revenue per active rider. That came in at $47.51. The estimate was for $48.52. We know Lyft has been lowering its prices in an effort to win back some market share from Uber, who is by far the leader within this category. But again, the better than expected guidance for the current quarter, also the beat that we're seeing on profit adjusted EPS of 16 cents for Lyft. That's a big reason why we're looking at shares up just over 12%.
And it's interesting to see the reaction, especially when you mention Uber. You'll recall when they reported their results, there was a knee-jerk sell-off initially of their results. When they were expected to post a loss at the time, and they certainly have a larger market share when you compare, relatively speaking, because at the time, Uber had posted a profit of more than, or revenue rather, of more than $9 billion. They posted their first ever operating profit, and the reaction was negative. Meanwhile, on the flip side, here with Lyft, you're seeing investors like, okay, we're on board with this one now. But it does go to show with both companies that you are seeing that ridership come back, that post-pandemic ridership, people clearly using these services between whether we're talking about business or leisure travel, or people going back to offices, companies calling people back in. So you're seeing that with demand with both of these companies.
Yeah, and there could be some talk about whether or not maybe this is the start of a turnaround for Lyft, because like I said before, we talked about the fact that Lyft had been lowering prices in order to boost their ridership numbers. And it's clear from these results, 21.5 million riders, up 8% on a year-over-year basis, beating the street's expectations. That strategy clearly working to some degree. Within this report, the CFO of Lyft, Aaron Brewer, saying that the rideshare market is growing. We had a solid second quarter, and we have strong ride momentum going into Q3 and the back half of the year. So again, at least the street initially very impressed with these numbers, with the stock up just about 14%. All right, coming up, we're going to take a look at Rivian, the company also just reporting its latest results. We'll bring those numbers to you as soon as we come back.
It's been a wild year in the retail space. Inflation has dominated the headlines, causing shoppers to spend more cautiously.
As a result, profits at major retailers such as Walmart, Target, and others have come under pressure.
Organized crime and a growing list of bankruptcies also continue to cast a shadow over the entire industry.
But what does this all mean for the future of the sector? Should investors dive in or steer clear of retail stocks?
We'll bring you key analysis and hear from some of the biggest names in the industry to answer key questions.
Who is the consumer visiting? What can retailers do to stop the rise in theft? Are more bankruptcies on the horizon? And where does AI fit into it all? It's all part of our week-long special, Retail Evolution, the New Era, starting Monday, August 14th, right here on Yahoo Finance. You won't want to miss it.
Shares of Lyft trading up just shy of 12% in after hours after reporting their quarterly results. For more on reaction on the numbers, we want to turn to Bernie McTernan, Needham & Company, Managing Director. So Bernie, let's get your initial take on their reaction. We're seeing the stock pop in after hours. They boosted their forecast coming in better than estimates. What's your initial take?
Yeah, no, the key thing here is the 3Q guidance for revenue about almost 5% better than consensus expectations. And then the 2Q beat on EBITDA, there was basically a 20 million sequential increase in revenue from 1Q to 2Q. Almost all of that flowed through to higher EBITDA in the quarter. That's what drove the beat. And the company continues to expect to expand margins in the third quarter. So, I mean, the key takeaway here is that consensus estimates have to go higher. It's really strong results by Lyft.
Bernie, do you think this is the start of a turnaround here for Lyft?
Yeah, it's really interesting. I think the comment by David Risher in the press release was interesting. That said, give Lyft its try, download the app. You think you'll like what you see. And that's the key thing for Lyft here as we enter the second half of the year into 24. Our pricing tracker shows that they have about a 20% lower pricing than Uber. I mean, they talk about being competitive, but either way, that conversion should be better now than it was last year. So what they need now is consumers to continue to download the app. And what you saw with active riders in the quarter, that surprised 2% above expectations. That obviously needs to continue to march higher. It's still below peak levels, but that's the key, is that they need that top of funnel to continue to grow, because it's really the price cuts that they did in the beginning of the year that should drive conversion. So I think the key is a top of funnel for them.
So Bernie, Uber is far and away the leader in this space. Do we expect to see Lyft gain more market share from Uber?
So market share for Lyft troughed around 25%. Because of the price cuts that started early in the year, it's gotten back to the low 30s. I think it's stayed around those levels since then. So that's the question, is that can they grow their profitability, grow their free cash flow, grow EBITDA at a 33% market share, or do they need to invest in more share? Because right now the conventional wisdom is that all the economic profit of the industry is going to accrue to Uber. That's the reason why Lyft's short interest is 15%. That's the reason why it's a consensus thought that it's a value trap. And so the stock has worked so far. Since May 25th, the stock's up 40%. That's relative to about 20% for the rest of my coverage. But over that time, the most dominant factor in the market has been short squeezes as hedge funds largely degross. So, strong performance on short covering, and I expect that to really be driving the near term as to your point, if they can be, either gaining share, and that's the implication, I think, from the 3Q print.
So Bernie, but just to make sure I get this right, it sounds like you still think Lyft is overvalued given that massive run up that we've seen since the low.
Well, no, the stock's cheap. I mean, this trading on 24, it's a low double-digit multiple. So that's the question, is how confident you are, and as we are investors are in that 24 estimate. And I would say that after a report like this, it's hard not to be increasingly confident and to think that 24 estimate is to be going higher.
Bernie, there's been some talk over the last couple of months that maybe Lyft could potentially be an acquisition target for a larger player outside of the space looking to get some exposure into ride sharing. Where do you stand on that? Do you think that that's something that we could potentially see down the line?
Well, DoorDash is always the big rumor, especially because the success that Uber has had with its Uber One platform and in terms of driving gross bookings. Tony, the CEO of DoorDash, has been pretty adamant that he doesn't want to go that route. So I think, maybe thinking outside the box, especially as, things like autonomous begin to take off. If one of those, technology manufacturers look at, not Lyft as a rideshare network of, hey, here's 22 million people who use it, on a monthly basis, and what that could mean as, for this kind of like ride sharing 2.0 for technology innovation. I think to me, that's probably the most interesting M&A. There's always Grubhub out there as well, too. They're for sale. So I think it's, the investor chatter certainly on food delivery, but I think, maybe a technology, even though we spent years breaking apart those companies, maybe it's time to bring them back together.
So, Bernie, one of the things the CEO mentioned in the press release on the earnings was the talk about summer travel, return to office, commuting, helping with regard to these numbers. But going back to like what we talked about in the potential for increasing any market share, pulling any away from Uber, how can they change that? For instance, I'm just one person of many. When I go to my phone and look for rideshare, I typically just really out of habit just go straight to Uber. Probably once or twice a year, I'll check Lyft. What are you looking to hear from them on the call about their marketing strategy and how they're going to try to pull more people into using Lyft?
Yeah, no, it's a great question. And so they've had marketing campaigns in the past where, they had one focused with a TikTok star in trying to gain top of funnel awareness. I was watching Peacock the other day, and Kevin Hart's Lyft Legend was being advertised, even though that show's a couple years old. I think it was relatively new to Peacock. So I think it's creative ways that going out and trying to get people to try both apps, because that's the power for Uber, is that they are the verb. I mean, it's the same kind of thing that Airbnb is benefiting from, where 90% of Airbnb's app traffic is coming to them organically. That's the same kind of thing that Uber's benefiting from, and Lyft is trying to break in. And again, like to pull it back to David Risher's comments in the press release, hey, give us a try, you'll like what you see. A lot of times it's the same drivers that are driving for Uber that are driving for Lyft. And so I think, if you're Uber, one of the interesting things to think about is the two different flywheels that I think are going on in the industry here. And one is supply. Uber supply increased by 33% year over year. They had a 7% higher engagement. So the more that they can surge less and reduce wait times, that's going to stop people from checking checking Lyft. And then the other thing is technology. And I think this is a really important conversation to have, especially with the rise of generative AI and how more efficient engineers can be. But Uber has 33,000 employees globally. That compares to 17,000 for DoorDash and only about 3,000 for Lyft. So I think, the viewpoint in terms of, are these commodity businesses, or are they technology companies where the products can continue to be improved? And that significant advantage that Uber has in employee count, because they're leveraging a global technology stack and global engineering base, could ultimately lead to further share gains.
You make an excellent point there, though, about the Uber being they are the verb. Like, for instance, when I talk to my sister, I'll tell her to catch an Uber, and I mean either, honestly, when I say that. But we're going to bookmark our conversation. Bernie McTernan of Needham and Company Managing Director, we appreciate your time. We'll certainly be watching that earnings call later.
Great. Thanks for having me.
Thank you.
All right, let's get to Rivian earnings. They're out just moments ago. We're looking at a loss of just about 1.6% on what looks like a pretty solid report, at least when you take a look at these headline numbers and also the guidance here coming into play. So second quarter revenue, $1.12 billion. That was better than what the street was looking for. Rivian also posting an adjusted loss per share, narrower loss than the street had expected, $1.08. The street was bracing themselves for a loss of $1.37. Rivian also boosting its full year production outlook. They now see that they expect to produce 52,000 vehicles. That's up from 50,000. And they also reiterated they recently initiated delivery of their Amazon electric delivery vehicles in Europe, also forecasting a positive gross profit by 2024. We know Rivian has taken a number of steps earlier this year to really try and slow the spending with the company. They also had a 6% staff reduction earlier this year. They also announced a $1.3 billion worth of sale of convertible notes back earlier this year in March, delaying the launch of one of its vehicles as well to 2026 from 2025. But again, these better than expected results on the top and bottom line. Also, the fact that the company boosted its full year production target doesn't look like it's enough for shares, at least right now.
Not right now. We'll certainly have to listen to what they have to say. But yeah, I mean, we're just seeing strong numbers across the board. The one thing I do note is the stock is up more than 43% for the year. So we know often the market is a forward kind of discounting mechanism. So there may be some cooling in that run up in the stock. But we'll certainly kind of dig deeper into these results to see if there's anything there, especially when it comes to guidance.
Yeah, certainly. And they're up against some tough competition, also some cost concerns that did lead to those job cuts earlier this year still remain just in terms of what the trajectory of Rivian looks like going forward. But again, year to date, like you're saying, we have seen a huge pop in the stock with shares still up just about 34%. All right, let's do a check of the market sponsored by Tasty Trade. Take a look at where the major averages closed the day. Once again, we were under pressure across the board, although the markets did close well off the lows of the session. The Dow off just around 158 points, S&P off about 0.4%. The Nasdaq, the worst performer of the three major averages, as we did see the tech sector among the worst performers of today. Nasdaq off just around 0.8%. Well, coming up, we will dig a little bit deeper into the results from Rivian. Also bring you second quarter earnings results from the dating app Bumble. We've got that for you when we come back.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Shares of Rivian now off just about 3% after the company released its second quarter results, a narrower than expected adjusted loss of $1.08. The company also second quarter revenue coming in better than the street was looking for. Rivian boosting its full year production outlook, yet we're looking at shares under pressure in extended trading. So here to help us make sense of all this, we want to bring in Jordan Levy, Truist Securities equity research analyst. Jordan, it's good to see you here. So it looks like a pretty solid print from Rivian, yet we're looking at shares under pressure in extended trading. What's your first take on these results?
Yeah, it's interesting. I mean, I think that all around the results came in better than expected. We like to see the guidance increase. I think it shows, Rivian's continuing to perform, continuing to gain that momentum. Now, like you said, shares had run pretty well into earnings. So there's potential that there's some sell-off here on, folks who are playing this for an announcement regarding an expansion of their commercial vehicle platform or something of the like. But I think from an execution standpoint, we really saw everything we wanted to see out of them this quarter.
And Jordan, to your point, I know you all put out a research note saying you were forecasting for them to produce 54,000 vehicles for the fiscal year 2023. They did boost their forecast a little less than you expected, but is that any cause for concern at all for you?
No, I don't think so. I think at this point in the game for them, it really comes down to what do the delivery numbers look like, and is demand holding up? And we'll get good sense of that, I think, in the upcoming call. But from everything that they've shown us so far with where the revenue numbers came in for the quarter, with where gross margins were and what they were able to do on delivery numbers, it seems like that's holding up pretty well. So I think the focus is really more on that than, a couple percentage points difference on production.
And Jordan, when it comes to production, the company here is citing progress we have seen to date on our production lines, the ramp of our in-house motor line, and the supply chain outlook. Those are the reasons for its revised expectations. How big of a catalyst do you see those production ramps and more insourcing being for Rivian going forward?
Yeah, I think it's critical. Look, there's no doubt this is a really competitive market. You have other EV pure plays they're competing against. You have all of the long-standing OEMs out there that are ramping their EV production. So look, Rivian being able to get their vehicles out to market, be able to do that profitably by boosting efficiencies through Enduro and other initiatives, I think is critical. And really where we are now is the market. I think some of the momentum the stock's gotten recently is they're showing that they can be a long-standing player in this space. And as they continue to do that, I think there's still a lot of momentum they can garner.
And Jordan, given these latest results, are you sticking by your buy rating and that $30 price target on the stock?
That's right. Yeah, I mean, we review all our estimates and whatnot after earnings, but yeah, I would say that the results have been very positive.
So what are you looking for specifically that may change your thesis there after their earnings call?
We want to see commitment to the initiatives that they've laid out. We want to see that it looks like the dual motor configuration that they started to roll out in their passenger vehicle segment is going well. It seems like that has the potential to, get them to profitability on that faster than we had initially expected. And so if those can be confirmed, I think that's very positive for where shares can trade.
All right, Jordan Levy, Truist Securities Equity Research Analyst. Thanks so much for joining us today.
Thank you for having me.
All right, you got it. All right, after the break, we're going around the horn, checking in on some of the top trending stories of the day. Yahoo Finance's Alexandra Canal and Josh Schaefer are going to be with us. There they are. Guys, what are we looking at?
Hi, well, we just have some breaking news coming out with ESPN, Penn, parting ways with Barstool.
ESPN's going to be getting into the sports betting game, and we're going to break down what's happening with all that news next.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Welcome back to Yahoo Finance Live. Josh Schaefer here with Alexandra Canal and Pras Subramanian. And guys, I want to start a roundtable today with some breaking news. ESPN is getting into the betting game. ESPN launching a betting platform with Penn Entertainment. Now, Penn Entertainment had previously been working with Barstool Sports. They had actually purchased all of Barstool Sports over the last couple of years. Part of this deal, Penn Entertainment is divesting its ownership of Barstool Sports back to Barstool Sports founder Dave Portnoy. So Penn no longer owns Barstool Sports, and it is now entering an exclusive partnership with ESPN, which we know is the worldwide leader in sports, to be ESPN Bet. You can see Penn stock reacting massively to this news, up 26%. A couple highlights from the release that stuck out to me. So it's going to be a legalized ESPN Bet app in 16 states where Penn currently operates. So again, we're talking about mobile sports gambling here, and we're talking about ESPN. So the most massive part of this release to me is being ESPN's exclusive sportsbook and having odds attribution and promotional services on the platform. So when you think about being on ESPN and having Penn's odds be on ESPN, that means someone like Pat McAfee, that's a very popular ESPN personality, when he's building products, parlays, saying he likes XBet, he's excited to bet on this, he'll be saying he's excited to bet on that on the ESPN betting platform, and then the game will start on ESPN. So you're getting a little bit more of that same screen experience, which is something we talk a lot about in online sports gambling. Fans want to be able to watch the game and bet on the game, potentially in one app. That's not necessarily where this is right now, but getting a more synergized experience here, Pras, is something that definitely stands out instantly.
Just a few things. So, usually when it comes to these types of betting and betting products and content, you're sort of curious, where can I make this bet? Who's giving me the odds? Where can I get this stuff? It's going to all be seamless now, is my understanding. It's one place, one-stop shop for ESPN content and also the bets you can place on top of that. A couple things that on top of my head is Disney finally getting in betting was something that I know was
Tiger has hinted that he's open to it.
Right, that they would never really do, but now it's happening. I think that's massive for them. But yeah, I think that's such a great over-the-top stuff you mentioned, right? What about when I'm watching the ESPN product and then they can fly in-game bet, right? It can be done via ESPN Bet. I mean, the integration of it is we're just scratching the surface of that stuff right now.
And can we pull up a DraftKings chart? Because this is interesting. After hours, we're down 8%.
Yeah.
So you see that competition. You see how ESPN entering the fold, how that's going to shake things up in the sports betting world. I mean, this is pretty big news. We were all excited when it was first announced because this had been something that had been teased. Of course, ESPN as well has been questioned about turning fully over the top, the endeavors there. Bob Iger said he's looking for strategic partners in that. Now we have the sports betting move, which you wonder if you can incorporate sports betting as you're watching on the streaming app.
Exactly. It's one of the major things that a lot of these companies have spent on.
Right.
We talk a lot about sports gambling marketing, right? And these companies have spent a lot to get their names in the right places. One of FanDuel's favorite things to talk about, FanDuel's the market leader. It's owned by Flutter Entertainment, which is in London. One of their favorite things to talk about is their prominence on the TNT NBA broadcasts. Charles Barkley does a parlay. He says, go bet on it on FanDuel. Fans love Charles Barkley. He's very funny. So then they go and do that, and they've seen and they've seen direct increases though when you're able to do something on screen. People are watching that pregame and then get into it. It's why FanDuel tried to get into content. It's why DraftKings has gotten into content a little bit. And now you see this move. ESPN was always going to be the ideal place. These guys have been advertising on ESPN. They want to be on ESPN.
It's like the reversal, right? You start with content and then you get into sports betting. Yeah, it's super interesting to me. And especially for a company like ESPN, also interesting that Penn is saying bye-bye to Barstool, which makes sense because I feel like ESPN.
We should mention Barstool had been a massive overhang on that stock and been an issue when Penn had tried to legalize in different states. There was a whole case in Massachusetts. Penn just legalized in Massachusetts a couple months ago now.
Your home state?
My home state of Massachusetts. But they were having trouble with some of the language that Barstool would use. One of the characters of Barstool, Dan Katz, Barstool Big Cat, ran this thing called the same game parlay, and he called it a can't lose parlay. State regulators don't like that because then gamblers think that they can't lose. And so they had a problem getting a licensing from that.
They don't. In fact, even with investments, they don't like that kind of language with investments.
Right.
That's frowned upon. So I kind of think about the content game now, right? So I'm not sure what it means for Fox Sports. What does it mean for NBC Sports and Roto-World and all those things? Do they now get their own partners like FanDuel or DraftKings? Is that the next kind of domino to fall?
Maybe they'll have to.
And it'll be interesting too, I should mention, I'm pretty sure Flutter Entertainment reports earnings tomorrow morning, so they will have a call. They don't always overly talk about FanDuel because it's a subsidiary of the overall London company that exists, but it'll be interesting to see what FanDuel, if they say anything about it tomorrow, because again, FanDuel had been sort of the market leader here in the US, and we just took a look at DraftKings stock off about.
Does this make, like, I mentioned the entertainment, the interactive TV element, does this make regular linear broadcast even more exciting because I can now integrate my ESPN Bet app with my ESPN whatever programming I'm watching?
You got to start thinking about tech, right? That's one of the things, though, that Penn had been considered to be a little bit behind on. Most analysts and different people in the sports gambling space have really talked up DraftKings and FanDuel for being able to be quick. Live betting is such a big part of this, being able to bet on the next play, being able to bet on the outcome of the next drive in football, or
that's
if
the
someone
holy
will
grail,
score a
right?
touchdown. Right. You make the most money on those kinds of bets. And Penn hasn't been able to get prices up as quickly, so the app doesn't load quick enough with streaming, so it's a little bit more difficult. But it'll be interesting to see now, is ESPN going to invest more in this? Is that where Disney's investing and they can get better tech?
Well, I was going to ask, why would ESPN want Penn? And would they even be able to launch something like this in-house? Did they have to partner?
Yeah, they always needed a book, right? Because you need the licenses too. Like you come with 16 ready to go states,
right?
Which is pretty eye-popping.
True.
That's what companies
and
want.
right away too, right? For the NFL seasons kicking
off, they're saying this
football.
fall. We're a month away from football season, so they should be up and running.
You need the experts, you need the guys that are going to come up with the lines and all the different bets and what they entail for all these different sports. Now, I mean, how many sports does ESPN have, right? I mean, you could bet on basically everything at this point. The Scripps National Spelling Bee, right? Could that be next?
Maybe. I mean, pickleball, you never know.
As long as my preseason NFL daily fantasy is not affected by this.
one question we were talking about too
for that process.
was how much money, right, was involved in this transaction. We don't have that information. Disney reports earnings tomorrow. I am sure that they're going to be asked a lot about this on the earnings call, on top of, the streaming ambitions of ESPN as well. So a lot to talk about here. But moving on real quickly to another type of entertainment story that we're all watching is AMC. AMC saw a really strong quarter. They were able to swing it to a quarterly profit, the most attendance since the fourth quarter of 2019. And it makes me think of that Nicole Kidman commercial. You come to this place to laugh, to cry. A lot of people came to AMC, and you would think that in Q3 they're going to be even stronger results because then you have Barbie and Oppenheimer baked in there. But in the background, this is a company that does struggle fundamentally. It does have some cash flow issues, and we have this writer's strike that I think the longer it goes on, currently there's no end in sight, that could cause a lot of disruptions in the back half of this year, and that could be really detrimental to AMC if those films need to be pushed into the beginning of next year.
Two things that stuck out to me just taking a look at AMC stock over the course of the day today. One, it opened up about 6%, and then I think it gave away most of those gains throughout the day. Just always interesting to watch a meme stock and how it actually moves on earnings day. It doesn't move on earnings day. It moves when they talk about ape shares and they talk about all these different things, or even when they talk about how many people go to the movies, but then it actually doesn't move that much on earnings day, which is just kind of a fun market thing for me to watch. But the other thing, Pross, that really stuck out to me about the last couple of weeks was the Barbenheimer revenue sales they got from food and beverage hitting, I think it was second all-time, Allie, for food and beverages from the Barbenheimer day, because they were able to get people in the theater for 5 hours.
Yeah.
True.
Can you bring back the double feature? Is this like any way that you can possibly bring back some form of a double feature? Because if I'm sitting anywhere for more than 3 hours, I know personally I'm going to eat something.
Yeah, I mean, what, 5 hours of movie content there, and you kind of.
I just saw Barbie, and I got popcorn,
Yeah.
I got Coke, and I got Swedish Fish.
Yeah.
And that was just a 2-hour Barbie movie. So I can't imagine those that did the double
If you
feature.
did the double feature, it's another source of revenue, right? Because we talk a lot about the fact that, you know, the movies are a lot of repeats. Maybe you're not getting enough people in there. Pras, you had a smart idea offline. I'm going to throw it to you now. You said, what if it's $5 to go to a second movie?
Yeah, so give me a deal, a double feature, whatever it might be. The second movie's $5. Just get me, because I'm in there, I'm going to pay money for the candy, the popcorn, all that stuff, right? The big soda gulps, whatever. But 66 million moviegoers there, right? In that second quarter, and then the most since fourth quarter of 2019.
Pre-pandemic.
I honestly never thought the movies would go back to pre-pandemic levels. Like, I thought it was done. There's too much good tech at home. I have a good TV. I got the 4K streaming, HDR. People want that social experience in the theater. They want to eat crappy food, maybe. I don't know. But a double feature makes sense, I think. And it's Barbenheimer was the thing that needed to happen, like, out of nowhere, blew it up. I think, Allie, you're right about the fact that in a year from now, if they're still striking, because you know, they got about a movie, like a slate,
And,
like a year
and even
worth of
after
films,
the
right?
summer, there's not too much on the fall slate, which is pretty typical. There's that seasonality factor in there, but I think these two movies just go to show that people are really craving original content, and that's something that I think is going to influence studios and the way that movies are produced moving forward. But we will be discussing sports betting, movies, all the things, and we'll be right back after this break. There's just so much to talk about.
Oh, yeah.
See ya.
Let's take a look at a couple of stocks trending after hours. We've got Lyft, Bumble, Take-Two, and Twilio. Kicking it off with Lyft, we're now looking at losses of just about 9% in extended trading. Their earnings call getting underway just a few minutes ago. A couple of headlines out of this call. CFO Aaron Brewer saying that they did see 25% more drivers on the platform in July. They do expect trip volumes to rise by about 20% in the third quarter, but Brewer also warning that Lyft does plan to spend a little bit more on marketing in the current quarter, an effort here to try and win back some of that lost market share to Uber. Again, on an intraday basis, the stock was up just about 5%, but that doesn't tell us much. So let's take a look at the 3-month chart. We have seen some momentum in Lyft shares, up just about 35%, but lots of questions just about Lyft and its ability to compete with Uber, which is by far the leader in the ride-sharing space. Let's take a look at Bumble, giving us a look at the dating app space when we're looking at losses of just about nearly 4% in extended trading, paying users that beat the street's expectations, but not by much. 3.63 million. Estimate was for 3.59 million. The company did top revenue. It was up 18% on a year-over-year basis, but it wasn't a knockout report. And we're seeing that reflected in the action in extended trading. Bumble app revenue, that was 208 million, up 23% on a year-over-year basis. Comparing that to Badu, its other app here, revenue from that stepping in at 51.8 million. Paying users there, just 1.18 million. This is a stock that we haven't seen much action, really. If you take a look at the overall movement, up just about 4%. We did see a peak back in July on the 3-month chart here, but again, not movement over the last several months. Let's take a look at Take-Two, giving us a look at the gaming space. That's up just about 2%. They're expecting a very big 2024. Some of the guidance projections, that is what's driving the action here after hours and really overshadowing what was a pretty weak quarter for Take-Two. The company saying that they're positioning their business for a significant inflection point in fiscal 2025, which gets underway next year. Speculation there that we could see the release of Grand Theft Auto 6. We know that that is the most important title in Take-Two's portfolio. Over the last 3 months, we're looking at gains of just about 11% year to date. This stock has been on a bit of a momentum here to the upside, up 35%, has lost some of that momentum as of late. But let's round it out with Twilio, that software play, up just about 7% in extended trading. They raised their full year profit outlook here. Revenue and profit also beating the street's expectations for its most recent quarter. So we're looking at gains of just about 7%. Year to date, the stock up nearly 20%. Over the last 3 months, we're looking at gains of just about 6.5%. So we know Twilio had been under pressure more so with the broader sector. We have seen Twilio announce 2 rounds of job cuts so far this year. They're trying to get their costs under control. The street at least pleased with what they see in this report, with the stock up just about 7%.
All right, time now for what to watch on Wednesday. Disney earnings are on deck. The media giant is set to report third quarter results after the close. Its streaming numbers to be a key focus amid rising competition and declining subscribers for Disney+. Investors will also be on the lookout for commentary on the future of Disney's ESPN and ABC network. Additionally, traders will keep an eye out for a read on the scope of future risks from ongoing Hollywood strikes. And more on the earnings front. Gaming platform Roblox to report results before the bell. Shares of the company have enjoyed gains of over 30% this year. However, analysts expecting Roblox to report a loss of 41 cents per share in the second quarter. Meantime, investors will be watching for additional information on generative AI efforts. And turning to the fast food industry, the pressure is on for Wendy's after McDonald's reported better than expected results last month. The fast food chain to offer a closer read on spending amid a more cautious consumer. And that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.